Okay, welcome to the Swing Trading with Cycles channel. Today we're going to cover bonds. We're going to look at bonds of different categories, and we're going to take a look and see how are they performing in 2022, how are they likely to perform in 2023. Big picture. This is really big picture because the bond market is much larger than the stock market, and it impacts the economy as a whole even more so than the stock market, partially because of its size. So we'll look at how the entire asset class, we'll do 5 things, right? So we'll look at how the entire asset class performed in 2022 and what that means potentially for 2023. Then we'll look at U.S. government bonds in 2 categories. We'll look at the short end and we'll look at the long end. And we'll talk about the Fed and how that all factors in. We'll look at corporate bonds briefly. And then we'll do a recap of the trading opportunities. And we'll talk about the trading opportunities throughout. We're going to talk about specific ETFs that track the bond market. And so let's jump into it, and I'll orient you with the tickers that we're gonna look at here. So the first one is BND. That's the Vanguard Total Bond Market Fund. So that gives you exposure to the total bond market, or the total U.S. bond market, excluding inflation protected bonds and tax exempt bonds. So really, pretty much the whole gamut, except for those 2 sort of specialty categories of bonds. And so this gives you a really big picture view of how the entire bond market is doing, at least in the U.S., right? And then this next category is just your corporate. And so we look at high yield debt versus investment grade. So actually JNK and HYG are both high yield, and LQD is an investment grade ETF. And we'll talk about what that means in this context as well. And then, just for your context, there are international corporate bonds that are available as well. This is one example of a fund. And then we'll go into the U.S. sovereign bonds, which is what we'll spend most of the time on. And important to understand, the U.S. sovereign bonds are going to sort of have a cascading impact, that they're going to affect really global to some degree, but more so the U.S. corporate bond market as well, because it kind of takes its lead from the U.S. sovereigns. And so what are we seeing from the total bond market if we use the BND, as our barometer? So this is the big picture chart, as we always do on this channel. We like to look at this chart that shows us every year every candle is an entire year of price action. So it's very big picture, and it reduces noise in that way, right? So this fund started in 2007. That's what this candle is, and it was a green year. And then this is our current candle, 2022, and this is December 8th. So we're relatively early in the last month of December 8th, 2022. So we're relatively early in the last month of 2022. So it's a great time to take a step back and reflect on how the year looks like it's panning out, and again, what that might hold for the following year based on the price action of the current. And so, as we can see, big picture, it was a really bad year for the U.S. bond market in general. It was a terrible year. But let's scan through some of these others, so this is the total market. It's an aggregated index, and so it's supposed to give you kind of a picture of that. And I'll also draw your eye to the fact that we have a big old swing high here, right? The move this year made 2020 a swing high, and we did that by crossing below the low from 2020, right? Because 2020 marks a high, and that's how a swing high works. If you make a low below the low of the candle that marks the high, that's a swing high. And more importantly, it means you've started a downtrend, right? That's important. Every swing high starts with a downtrend. Not some of them, not like 98%, every single one, 100%. That's literally the way price aggregate. That's how price moves in a trend, right? The start of a downtrend is by definition a swing high. And so this would suggest that we may have started a downtrend on the highest of time frames. Again, this is the aggregated U.S. bond market. If we look at a measure of corporate debt, this is high yield debt. So it comes at a higher interest rate. You can see we actually made our high back in 2007, and we've just basically been in an ugly downtrend. So that's high yield debt itself. JNK is a similar measure, and notice also downtrend. So that made it swing high a much longer time ago. And so what this tells you is the bond market as a whole was much more healthy than like the sort of high yield market. And this is LQD, which is investment grade corporate debt. Well, what do you see here, right? Isn't that interesting? LQD has the pretty much the same pattern as the total bond market, which is to say healthier than high yield debt. But we've obviously got a big crack in the armor now because we have a swing high on 20. And you can see this line I had drawn previously. We have a swing high. In this case, by going below, what's the level on this one? 104, $105 essentially. And that was actually your COVID low. Now, importantly, price is now actually back above that. We're now at 110 and that low is about 105. So we're 5% off that low, which is actually a big move. And that's a general theme that we are seeing a bit of a rally when we'll zoom into the lower time frames. So that's LQD. If you look at, oh God, that's corporate. That's international corporate. That has a swing high back in 2014. And this is just one index. Not sure how representative this is of the whole. And then if you just look at the few ETFs that track the government bonds, this is a short end. Again, you see, it's not a coincidence that you're seeing the same pattern for different segments of the same bond market, right? Like swing high in 2020. This is a short end of the bond market. ETF ticker symbol SHY. And TLT. What do we have here for you? Oh, what a coincidence. A swing high in 20, and you can see I have a lot more annotations on this one. I've been following this a lot more closely. I use this as a bit of a trading vehicle. And TLT, that's a swing high below 136. My God, we're down here at 109. And this one has been rallying pretty furiously. But this gives you a measure of how far we're still below the 2020 low, making this kind of a massive swing high. And let me see if can I pull this up from a different source? Is that an option? Let's see. Okay, that's just to kind of clean it up, so it's easier to see. Again, same pattern as all the others, and so let's dig into the bond market, the total bond market now. Again, now we're looking. So we saw a big picture. Things look ugly. Okay, got it. What do we look like if we zoom in on a quarterly chart now, for instance? Right. Let's see. Do we have because we had a big red candle on the monthly, or excuse me, on the yearly chart, so the full year is quite red, but the quarter is green. That's important to know about. That lower wick that you saw in the yearly chart, that is caused by this quarterly candle, right? One way you can almost kind of think about it visually is this green candle is literally the wick on that annual chart, right? And the bigger it gets, the bigger that wick gets, until it gets so big that it actually flips to green. We're not going to have enough time left in the year to do that. But that's what this is trying to set up, right? Like you can imagine if we get follow through, if this pattern holds true as it, typically plays out, you get something like that, right? And it's important like how that develops because at this point, and this is the BND index, let's talk specific levels. The high from last quarter was $77.18. So you really need to get back above that. And so we're probably not going to get there by the end of this month, but you could see a world where the Q1 2023 candle comes in and takes that high out. That doesn't mean we're out of the woods because remember, a downtrend is lower lows and lower highs. We would still be at risk of this becoming a lower high, but all the same, it tells you there's an interesting trade here that you can rise by a lot percentage-wise, even if it's in a big downtrend, because we're so incredibly kind of in the hole. I mean, look at this just waterfall decline. Again, downtrends need lower highs. This is a lower high as an example, right? You had this big red quarterly candle, but then it consolidated. That's what the lower highs are. They're consolidation, giving price a chance to aggregate so that we can begin the next leg lower, right? So after this consolidation of 3 quarters, boom, big can move down. So you could even have another positive candle again for Q1 2023, and then boom, another leg down. That's what we want to kind of that would be what we would be kind of watching for. But right now, this thing seems to have momentum that I would suspect we get at least another quarterly candle. Again, even if we get that big move, that big leg down. And if we look at the monthly chart, that quarterly candle that's green is being caused by these 2 months, 2 beautiful green months, and this is your December candle. And just to put a finer point on this, I'll go back to the quarterly candle, and definitely if you haven't seen the video that talks about how to identify market bottom, how to identify swing lows, you want to take a look at that. You also want to understand how to identify swing highs, right? This is your swing high. That's your swing low. Let's just be really clear about that, folks, right? And this is your quarterly candle, right? That's your swing low. That's bullish. And we talked about swing highs. We just talked about swing highs on the annual chart. That's your swing high. So that's your swing high on the annual candles, which becomes a swing high on the yearly candle if we get follow through, which we did, right? We kept going lower, so it eventually went below. Like, to be clear, this is your 2020 candle. This is it. That 2020 candle is being held up by this big doji quarterly candle. Once we went below the low of that candle, that was the low of 2020, and that's where we are right now, right? And so if you think about, so we have this swing low here on the quarterly chart, and that is being caused by this swing low on the monthly chart, right? That's how it works. Whenever you have a swing low on one time frame, it means there are swing lows on lower time frames that have had bullish follow through. And so that's why you got the swing low, right? Like, that's the whole point. Like, you have enough daily swing. If the daily swing low gets follow through, it becomes a weekly swing low, and that weekly swing low becomes a monthly, quarterly. So this is the monthly swing low from October, that's causing the swing low on the quarterly. And if we zoom into our weekly, and this is where the cycles perspective comes in, and I won't go through each one in as much detail, but you can kind of do this yourself. You can pull up a chart, right? We made a weekly cycle low very clearly on this week here. Like, you can see the weekly cycle low is just a swing low that had enough follow through that became a swing low on the monthly. And again, we can see it as swing low on the quarterly. So that's this swing low that happened the week of October 17th, right? So your October bottom in bonds for now, right? And since that swing low, we've rallied 1, 2, 3, 4, 5, 6, 7 weeks. This is our 7th week of rallying, right? Now, draw your eyes somewhere else. Do you see any other swing lows, right? Like, was there another cycle low that happened? That's right here, right? Like, and we don't even have to count out all the cycles. You'll see my other videos. Definitely make sure you understand cycles analysis. It's invaluable. But you don't have to like do a really, really detailed count on everything. You can kind of do a little shorthand here. This is another really like little weekly cycle rally. So this one lasted 1, 2, 3, 4, 5, 6 weeks. What is that high? 77, 17, 70. Oh, so actually call it 7 weeks. This actually made a slightly higher high. So 7 weeks. So that's 3, 4, 5, 6, 7 weeks. So what do you know? Wait a second. That's a little awkward. We're on week number 7 right now, right? So now it's a question. Is this going to be a rally similar to this other rally that happened? And this bottom was in June, right? Is it going to be a similar situation where, and just to be crystal clear, this week 7 that I'm drawing here, it's week 7 because it means that's the week where we've created a swing high and we started the weekly cycle decline. And so we started our decline. So we rallied for 7 weeks and then we declined for, what is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks. And so we've rallied for 7 weeks now. Are we going to continue to rally? I suspect my hunch is that we continue to rally at least up to this line here, that 76 level. And each of the different charts are going to have their own equivalent level of what that is, but it'll be a similar kind of idea. That's where that swing high was created. And so maybe like at some point this weekly cycle is going to end, right? In the same way, like this is another weekly cycle, right? This was a longer one. This rallied for much longer and then it declined. This is another weekly cycle and then a decline. And so these are obviously more vertical than those. I mean, and this was obviously a huge kind of descent. But that's how we want to watch this. And as we're thinking about a trade, we would zero into the daily charts. So the same way that we have a weekly low, well, we saw a quarterly low, a monthly low, a weekly low. Well, that's right. You guessed it. That's created by a daily low, right? A daily swing low. And that also becomes our daily cycle low as we're thinking about the cycles analysis perspective. And that's incredibly helpful because it gives you an opportunity to time when different turning points are going to happen. You'll never know for sure in advance, but it at least allows you to estimate. And how does it do that? It's the same way that we just looked at that weekly chart and we said it rallied for 7 weeks. Well, let's look right here, right? How long have we rallied here in days, right? That was looking in weeks. This will obviously look in days. So we rallied for 32 days. Like yesterday was day 32. This is actually day 33, and we haven't made a higher high yet. So it is very possible that this is our daily cycle high, right? And that's okay. Think about it that like within a weekly cycle, you're going to have multiple daily cycles. Just like within a longer term cycle, you're going to have multiple weekly cycles, which within them have multiple daily cycles. All that to say, you're going to have daily cycle declines within a weekly cycle. You just need them to be relatively mild, because if they're really, really severe, then that means that the weekly cycle decline starts, and then we're declining. Like, so I'll give you an example. So this is a 33. So we've rallied for 33 days, right? And we know that was the same 7 weeks that we just looked at. Well, remember that last 7-week rally we talked about? Well, that was also a daily cycle, right? And that was a rally that lasted, oh, well, what do you know? 31 days, right? And here's the important part. It lasted 31 days, like the rally, but the decline, man, that thing could take your breath away. That lasted really long because we didn't get our bottom until here, right? So day 91, so we declined for basically 60 days after that, right? And there were times when price tried to rally a little bit, like this was a little rally it tried to stage. This was a little feeble rally. We actually even closed above the 10-period moving average. So actually, you could say this was actually another daily cycle. I might, because this moved a little differently to TLT, and we'll look at TLT briefly. Again, I'm using this as a proxy. You can use the same principles on all the others. But look at this. We have a little swing low, 1, 2, 3, 4, 5 days. So we top out on day 5. So that's a really bearish daily cycle. So we already know that this daily cycle is not like the others, right? This one rallied for 5 days and then made a lower low. That's the way that you think about it. How long does a rally last before it kind of rolls over? And the worst rollover you can have is where we break below the swing low that started it all, right? And so we know that this rally has clearly had some legs, but even this rally, which also had some legs, topped out on day 31. So now is not the time to be chasing it. If anything, now is the time to be cautious and watch the decline. Are we going to get something like this, right? Or are we going to get something more gentle, right? Like, like think about, like this is the trend that we've had so far. We've gotten like that, like that, like that, like that, like that, like that. So we're going to get something like this maybe, and then like that. That's what we want to watch for, right? Because we could instead get something like that. Wait, like imagine we get something like that, right? And then it does something like this and that, right? Like that's what we want to be careful. That's what we want to, and obviously this would come in like here. Not to belabor the point here, but you get my point. Like imagine that, right? The point is we're going to get a decline. We want, like if it looks like it's turning out like this, that tells us a different thing versus if we're going to get something more gentle, that's going to just continue the uptrend, which, obviously if you're long is what you want to see. So that was a really detailed review of the total bond market. And again, what you're going to find is that most things are doing are in a very similar shape. So looking at the corporate side of things, same kind of idea. And we'll look at the weekly cycle rallies here. So again, same exact principles, right? In this case, we have rallied for 7 weeks. So we have a top on week 7, and it's currently week 8. So we're in a situation, and you can see this is another rally that was about the same in terms of length. So it's the same kind of situation. That's HYG. What about JNK? Same kind of idea. So this rally was 1, 2, 3, 4, 5 weeks. So we're getting to a point where if this is going to be a lower high, the weekly cycle would start to roll over. But we're also at a place where we're going to get the daily cycle decline. So it's a really tenuous spot, but it's also good because it'll bring really good clarity. We're either going to get a violent couple of days down that's going to tell us, oh, this daily cycle is not going to be this daily cycle is also going to be a weekly cycle decline, or it's going to be more gentle. It's going to hold the 10-day moving average. That's one thing that you want to see, that we don't go too much further below the 10-day moving average, and we don't start making new lows on the weekly chart. That's the other big signal. And so this is LQD. This is investment grade debt. So it tends to perform better than like high yield because it's better credit. And just like the total bond market, you can see. I didn't mention this in the other one, but like the actual percentage increase has been larger here too. So that's 12%, whereas this rally petered out at less than 7%, and it rolled over. So these are good signs. These are telling you there may be a character change here. But again, we want to watch and see how this decline unfolds, how this daily cycle decline unfolds, that is, because we want to see, is the daily cycle decline going to turn into the weekly cycle decline? If we look at corporate, international corporate, I should say, this was a really short rally, 1 to just 3 weeks, and then it petered out. But look at this rally. So this is telling you that bonds are waking up. And I want to be clear, because I think it can get a little bit confusing with bonds, the way it works. When these funds are going up, that means yields are going down. When these funds are going down, it means yields are going up. Another way of saying that is we saw those yearly charts, everything was blood red. That means yields rose dramatically this year, right? Like as bonds get sold, the yields go up. As they get bought up, the yields go down. And so these have been sold to death, but now buyers are coming in. This is international, and my God, look how far below the 200-week moving average this is. And that's just another thing to just note. Look at these. That yellow line is your 200-week moving average. That's HYG. What does the total bond market look like? So for the total bond market, that moving average is up there at around 83, and we're down here at 73. That's a huge move for an index like this, and that doesn't mean we're going to get all the way back up there. If anything, this is probably telling you there's more down. Like this is more suggesting that this is a rally within the context of a bear trend. But that just gives you a sense. We could get a pretty furious rally, and we already have had a furious rally in percentage terms, even if we're going to get a bearish conclusion. So let's look at the U.S. government bonds now. As I said, we'd spend most of the time. And honestly, that chart with the total bond market, that's being driven by U.S. bonds for the most part. And you can see I've listed them all here. We won't look through all of them. But this is the 3-month bond. So like this is the yield on the 3-month bond. Look at how it just went through the moon. And that's because the Fed was raising rates, right? And this is the short end. And the Fed, you'll hear people say that the Fed doesn't control the long end, they control the short end. So the Fed has been raising rates on the short end for all intents and purposes. So that means if you don't want to own short bonds on the short end if the Fed is raising rates on the short end, because raising rates is essentially like selling, right? And so this is what you got, and just a huge increase. And this is your 1 year. You'll see it's the same pattern. This is your 1 year treasury, and this is your 2 year treasury. So these are components within an index, within an ETF, I should say, called SHY. And so remember, as I said, it's an inverse relationship. Yields go up, price go down, price go up, yields go down. And so you can see the same way we had that vertical move, we've had this like near vertical drop for this index, yet still not huge in percentage terms. I mean, we're talking about dropping from 87 down to 81, right? So not even down 10%, right? But this thing generally doesn't move in that kind of fashion. And so if we're going to see like that, the beauty of this is that like you can see the way this thing kind of moved. This is actually when the Fed stopped raising rates last, right? Like they stopped and they started cutting again, right? This was like your Christmas, this was around like your Christmas 2018 pivot. And so the same way this thing fell off a cliff, it's going to rise dramatically as well. Now, this doesn't have a lot of as much juice just because it's like the percentages just aren't huge. And that's where that takes us to the long end. So the long end are things like the 10-year. So this is the 10-year treasury, the 20-year, the 30-year. Those are all, and we'll zoom out again so you can just kind of see how they look. We'll focus on the 10-year since the 10-year is what is the benchmark, what most things are based off of, like mortgages credit card rates, etc. And so I've called this out on Twitter quite a bit. We're in weekly cycle decline, right? So you can see that was the top of this weekly cycle. We had a pretty furious rally, a pretty massive increase in rates over this week. So this was like 11 weeks of rising. And so now we've been falling. It's almost like a symmetrical move down. But bigger picture, and this correlates with the total bond market because as I said, everything like things are generally driven by things are generally driven by government bonds. We have been rallying. Now that's telling us the price. We want to see time. I mean, it's been a big move in percentage terms as well, but more important to understand how long we've been rallying. So we've been rallying for 31 months, which is what I've pointed out on Twitter. Like I've been, so that is a really, really long rally for pretty much any asset class to rally for 31 months. And so, and you can see like previous, and like this was a pretty long rally. This was back in the late 70s, right? Like let's go ahead and just look at how long a rally that was actually, right? Like let's just do the work here, right? So that's a rally of only 16 months, right? This rally was 15 months. This little rally was 13 months. And we don't have to categorize every single one, but this is just giving you kind of a flavor, right? Like this little rally was do that again. Call it 16 months. So you're starting to, and this is going back. That's now we're in the 90s, right? Like what was this rally here? So this little rally, 27 months. So now you're starting to get to longer ones, right? That's interesting, right? This one was 17. You're starting to see a pattern of 17, which makes so it rallies for like. This looks like it was a longer one, but it's also not super vertical, right? So that's technically 49 months, but it's more sideways than anything else, which who knows? It might be telling you that ends up being something like what we get, right? But what this is telling you is that 31 months is definitely not necessarily the norm. And just to be clear, I'm measuring swing low to swing high, right? And so we've got this swing low here. And we rallied, and certainly this was a swing high. I would call this some kind of little like half cycle low, you can almost say. Like what month was that? Oh, month 12, interesting. Because it's still preserving the larger uptrend that we're in, right? Like, and this is one of those things where you'll know in hindsight, right? Like in real time, it's like, oh my God, is this cycle rolling over? And you'd be fair to think that, especially as you have this series of swing highs potentially, but then we get this rebound and then make higher highs, and you have these two dramatic months. So this is telling you that we've probably topped out for the longer term cycle, right? And now what does that mean in terms of declines, right? Like look at this thing that rallied 26 months. Well, how long did it take to get to the low? Well, that was 43 months, right? And like you can do the math on that. If it rallies for 26 months, but the whole cycle lasts 43 months, that's a lot of months of decline, right? And here we've only started to decline for a couple of months, right? This goes for 48 months, right? Like, and I'm not going to do all of them, but you get the picture. The declines tend to last the order like several months, not just one or two. And you can say, well, what about this thing? What about like the difference is that this is happening after rallying for 31 months, which tends to mean potential exhaustion, right? Like this thing can't go much higher like after making this huge move. And as we talked about, this is the yield. And so for the funds, for the bond, the price, it means price has been going down. So it's almost like saying we can't just keep going down. We can't like fall through the floor. That doesn't mean we can't go on to make a higher high, go back and like test this area here around 5% even. But we're probably going to have a cool off period. And guess what? This correlates with mortgage rates, as I said, and everything else. So if this is cooling off, then it means consumer debt rates are going to cool off as well. The 7% mortgages we keep hearing about. Like, this doesn't tell me that we're going back to like this tells me that we're probably going to stay around this area where we are and probably go even lower. My expectation is that we eventually break below this low here, which is 2.5%. I know that sounds crazy where we are here, but if we've already topped out on month 31 and we've only been declining for a couple months, it leaves a lot of time left to decline, right? And that potentially means we start to take out some of these pivots as the trade sort of unwinds. And that would mean upside for these other, for like the bond funds. So let's flip to that. Let's flip to TLT, right? So TLT is probably the preeminent way to play this. This plays the long end of the curve as the long end, and as we just talked about. So 1, 2, 3, 4, 5, 6. So this is week 6 of the rally, and you can see the previous rally was 7 weeks. And similar to the other ones, that rally was pretty feeble in percentage terms. So we rallied, less than 12%, whereas here we've already rallied 20%. Now, what we want to see, as we talked about with the other ones, and this is when I'm actively trading, I try to focus my efforts on this one. It's very big and liquid. You can see, like, let's zoom in on the daily cycle here. So I was in this trade and I stepped out, but it then gapped up, or I should say I lightened up dramatically. I still have one contract, literally, but we're now this is not the place to chase it. This blue line here is your 10-day moving average. Generally, price is going to check back to the 10-day moving average, especially as we move into a DCL. And so you can imagine we're going to get a retrace at least back to that. And now this is rising with every day, so it's going to be higher every day. And so not saying we're going to necessarily come down here where it is right now, but at some point this is going to check back. And again, as we talked about, we want to see that this is a gentle move lower before resuming the uptrend versus something more violent that is potentially going to be a weekly cycle decline. And so specific levels for TLT, the low from last week is 104.90. 105, and so we only have the rest of today to trade and tomorrow, and so we're gonna want to hold this low when we go into next week, right? I was thinking we might get a red week this week, but it makes more sense now with the FOMC and the CPI catalyst. We'll get a real resolution next week. That's probably going to be lower because we know and that's just a good rule of thumb. If price is just moving really vertically into a catalyst, it's probably going to decline, maybe spike and then decline. We'll watch price in real time, as we always do. But again, knowing that we're on day 31, the other thing to call out is the last daily cycle actually only lasted 31 days. So similar to the bond fund that we analyzed, very similar price action. So again, in terms of timing, we've rallied for about as long as a daily cycle tends to rally. And you can see in this bear trend, we had much shorter rallies. This is 14 days, 5 days, 8 days. And then this, even in this more bullish trend, you can see we actually had one where we rallied for 39 days. So that's good to know. And that might be something that might be what we're setting up for, right? We continue to rally into the FOMC print, December 14th. And then we finally get our move down into a daily cycle low. And again, we watch to see if that's a gentle move or something more violent that might tell us, the weekly cycle decline is starting. So that's a lay of the land. I think there's going to be more upside in bonds, but I do think let's go back to the total bond fund and let's look at the quarterly chart. We just need to be prepared for the idea that this is actually we're gonna test these all-time lows. We didn't actually get there, right? And so if you notice how this downtrend is playing out, like that, then like that, then like that, like that, and like that, maybe we get something like this and then that, right? We have to be vigilant for that. Now, my point though is a lot of money can be made up here, and this I'm thinking TLT specifically using options. And then certainly if we do see we're going to roll over, a lot of money can be made on this downside as well with puts, or TBT is another one we didn't look at here, but that's essentially your inverse of TLT. Although It is a leveraged ETF, and I don't love those. But the point is, there's going to be big moves coming out of bonds, and that becomes a catalyst for really good sort of low IV trades and options, for instance. And this is just important to know about, just because it affects everyone's lives so much. Again, mortgage rates, etc. We just have to be vigilant. Look at this little cluster of high. Like, we had this little 4 or 5 month period of green months, and then a big move down, then consolidation, big move down. We just have to be vigilant that this doesn't become another, couple of months of up. Which my base case right now is that is what we see, and that is in large part because the 10-year yield, I suspect, has topped out in its cycle, right? Because it's rallied for 31 months, it needs to take a break, and so this is that break, right? Like, we're probably going to see more appreciation, but when we get a cycle low in that is going to cause a furious rally out of that low, which is going to cause prices to go down. Right? Like, as yields go back up, prices will go back down, if that makes sense. And so you got to be nimble to play both sides of the trade. But right now, it certainly has been up since October, and we're going to have to see how this daily cycle decline plays out to see if we continue to see that upward momentum again to take us, even if we're going to go to like some kind of lower high kind of area. So I'll leave it at that. I know this was a long one, but very important kind of macro trends, and just really exciting that we can use the charts to really understand these big picture concepts, the directions that they may be going in a just very data-driven way, not biased. We're not trying to insert thoughts into people's heads. We're just looking at the math and seeing how it plays out. So thanks for watching, and I'll definitely be keeping track of this as things play out. Maybe some kind of monthly or quarterly update as it makes sense. But let me know if you have any questions in the comments, and thanks for watching.